This is going to be the cleanest show we have ever done. I'm not going to be as the comics.
Look how clean his t-shirts are. Never worn.
First of all, we're twinning. As the comedians say, I will not be working blue today. No F-bombs. Michael's not going to goad me. No BS. No a-hole. Nothing.
Goad?
Well, I'm saying, like, you're not going to say something that makes me go, oh, right? We're going to be on our best behavior today. Yo, these shirts come from the shop. I don't know if you guys are taking advantage of the new Compound merchandise store, but there is a link below if you want to hit that up. We didn't plan this, by the way, and compared to Mike, it looks like I'm stuffed into a ladies' medium. I don't really know what to do, but whatever. I'm feeling it. All right, let's do some quick. Well, what do I want to do first? Oh, so let me introduce the show for the first time, people. I've been told I should do that more often. This is What Are Your Thoughts? We do it every Tuesday, live at 5:30 p.m. Eastern. We take on the hottest topics on the street, things that everyone's talking about this week. I think we do a pretty good job. Michael Batnick is my co-host, here with me all the time. Michael, how was your weekend?
Cloudy, with a chance of meatballs.
And then Game 4 was an abject disaster. Yeah, dark. All right, Duncan's in the house. We're going to do some viewer topics today. You guys are giving us great ideas for the show. Please keep them coming. The email address is in the description below. Also in Duncan-related news, we're launching a brand new podcast this Friday. Quite possibly the most ambitious thing we've ever done to date on the compound. So pretty exciting stuff. Let me do some quick shout-outs. Mark Lastman is here. Steve Leon, the highlight of my week. Me too, Steve. Christopher Caslin, Stephen Lippold, Marco Z got here early. Darius is here. Who else? I could do a lot of these. Tom Whalen is here. Tim Stewart, Lurking Caro, Joseph Oppenheim, Mike Marlowe. All right, let's get right into it. Duncan, hit the thing, and we're going into the first topic. So I'm going to go out on a limb and say this. If regular, normal people, not pros, but like regular investors are going to do anything stupid with their portfolios this year, I think it's going to be something that they think is really clever to try to outsmart inflation. Like, I think that's going to be the trap that like normal people fall into. What do you think?
Meme stocks. Maybe.
Do you think that's the trap? I feel like that's so last year.
Yeah.
I don't know.
It's back. No, I think you're probably right. If investors are going to outsmart themselves, it's going to be with inflation products.
Yeah, that's what I mean.
I agree.
This is from the Wall Street Journal. They did this thing, the Wall Street players who worry about inflation, blah, blah, blah. The solutions to this supposed problem are getting increasingly more bizarre and complex. And here's a quote that I thought was interesting. In the past, when things got rocky, the Fed boosted liquidity, meaning over the last 30 years, which cut the cost of credit and ultimately buoyed stock prices. That was a virtuous circle. While inflation was low, the Fed would step in whenever volatility jumped. But it will now become a vicious one, according to Christopher Cole. The Fed has promised it won't tighten monetary policy until inflation is well and truly here and has run hot. This means the Fed will end up restricting credit when higher inflation is already making markets more volatile, and that action will feed volatility, making things worse.
Yeah, he's a vol guy, and every time I listen to him on a podcast, he's super bright, but just absolutely scares
I don't know anything about him.
Scares the shit out of me. Every time you listen to him, you do not feel good about the world.
He's a Fed is trapped guy.
Yeah. But he's a long vol guy.
Or they're out of bullets. What do they say? The Fed is out of ammo in case they need it. Yeah. I don't know, because I think even if you agree with that take, that doesn't mean a five-legged stool in an alternative asset management product with all of these different sleeves that are supposed to do this special thing for this perfect inflationary storm is actually going to work.
He's talking to his audience, as are we, and right. I think that the difference between now and previous environments is that if we do see inflation, if we do see interest rates rise, at least when you saw inflation in the 80s, interest rates were, at 8% and making their way higher, even higher than that. But right now, if we do see inflation, if we do see rates rise, like it's so easy to prey on those fears, don't you think?
Yes. And then what did we learn last year? Like, what's the most important lesson? Even if I gave you the economic data in advance,
right,
you still couldn't predict what the asset markets would do in response to those economic conditions.
True.
Like, didn't we just get walked through that lesson in a major way? So if I told you the Fed was just going to continue to keep their foot on the accelerator, and we were going to be at 3.5% CPI, trending toward 4%, you still don't know what that would mean for the asset markets. You know what it would have meant historically. You know it wouldn't have been great for bonds. You know it would have been great for things like student debt holders who have their debt at a fixed rate and see that get inflated away. Like, you know some of those things, but you don't know the whole puzzle. But neither do we.
Of course. But there is a demand for these products. And when I say these products, I'm thinking of one, IVOL, the quadratic interest rate hedge. Look at this thing. Right place, right time. Perfect trade for last year. Yeah. But if you hit it big, like, my God, there is investor demand for these things.
Just for people watching the show that aren't staring at the numerator and denominator, this isn't the returns of the fund. This is the assets coming flying in the door as financial advisors scramble to provide an answer that seems sophisticated.
And in fairness,
in
fairness, it's done well. So there's that too.
It has done well because nothing will attract flows to that degree if it hasn't.
But I think this is a potent story, and we're going to see more of this going forward.
I'm getting an email every day from this guy, INFL. Is he hacking you? It's like Horizons Kinetic Inflation Beneficiaries.
Yes.
Oh my God, guy, I'm not interested.
Right. Let's talk about meme stocks.
But I agree though that these are going to be really popular, and with good reason. I understand why.
But one more thing, hold on, just before we move on. You know, the thing with that is, I feel like how dangerous is that? Nobody's going all in on those type of things. You know what I mean? So like, even if they don't work as advertised, the danger there from the investor point of view, like, is relatively
I don't know if
small.
that's true. I don't know what the hell those funds are doing. If there are futures contracts that need to be rolled in these things, I don't know what they're doing.
But my point is, it's a piece of people's portfolio.
Hopefully.
So okay.
You don't think they're pitching themselves as core right now?
They might
core
be.
Is how you raise the real money.
I'm sure they are. It doesn't mean that investors are taking the bait. All right, meme stocks. How the hell did these come back? It's so bizarre. So before today, I had two things in the dock. I had AMC options go bananas. That was one of the images that we had. Not yet with the Mudrick stuff. Show me the options. So we had the options chart going wild. And then we also had something from Postmarket said, just a bunch of retail investors trading $500 million of meme stocks in the pre-market.
This is options on AMC.
Right. So the tweet was, again, this was from, I don't know, this is from, call it Wednesday, Thursday, whatever. Just a bunch of retail investors trading $500 million of meme stocks in the pre-market. In other words, this is not just retail. It's just not. There is big money following, I'm using this pejoratively, the smart money is following the dumb money, whatever. It's not just retail. And then today, the cherry on top of the story was what's going on with Mudrick. So
wait. Before we go to Mudrick.
Yes.
First, I am officially not using the term meme stocks anymore. I've used it in the past. I feel like it's offensive. I really do. AMC has
since when do you care who you're offending?
I really do. AMC has 39,000 employees. They have 1,000 theaters. Do you think these people wake up in the morning and say, "I'm going to go to my meme job"?
Dude, erroneous. Come on.
I don't know. I don't love it.
Get off your soapbox. It's erroneous.
All right, but here's the real thing I wanted to say though. Yeah. Before we leave this topic and go to Mudrick. What did I want to say? Oh, these are reopening stocks. That's why they're back. Hertz and AMC are two of the biggest beneficiaries of travel and people going back to the movies. So that's why they're back. Because actually, thematically, they should be back.
Okay, what
These
about GameStop?
companies are going to do well now.
What about GameStop? Is that a reopening play? Don't
special situation.
All right. So here's the deal. They bought $230 million worth of shares. No, I'm sorry. That's not right. Where's this data? Okay, they bought 8.5 million shares. So yeah, they bought a lot. And so that the news was released this morning. And then 6 hours later, we found out that they sold it. So AMC executives in the filing said our market capitalization as implied by various trading prices, I don't even know what various trading prices mean, currently reflects valuations that diverge significantly from those seen prior to recent volatility and are significantly higher than our market cap, whatever. He said, to the extent that these valuations reflect trading dynamics unrelated to our financial performance or prospects, purchases of our Class A common stock could instir substantial losses if there are declines in market prices driven by a return to earlier valuations. You think?
That's the company's statement or Mudrick's statement?
No. That's the company. So Mudrick bought it, filed, sold. Who's holding the bag?
They have to cover their. I can't even say the words I want to say.
Who's going to be holding the bag?
Well, first of all, let me congratulate Jason Mudrick on his subpoena and/or investigation.
No, why? This is all disclosed. This is not. It might be.
I feel like no, I don't think he did anything wrong. But if the stock collapses, it doesn't matter if he did anything wrong. If people are mad, they're going to be mad. And brilliantly, he got a clause in the way he was able to liquidate the stock. He was basically sell at will. Now, so let me just say one thing. You might hate him if you're a shareholder and this thing gets killed now with all this new supply. It hasn't yet. But you should really keep in mind that what he did is enabling the company to get better terms from their current creditors and is actually helping long-term shareholders. It is. If you're going to be a long-term shareholder, that money raised is great. You might not like the dilution because it's instant and it's not a big vote of confidence from this buyer. But in the end, how expensive is this financing, this equity financing? Very dilutive, but how expensive is it versus trying to do another debt offering right now? I don't know. I'm sure they did some kind of calculation and said it's better off to let him sell.
So $230 million on $16 billion is a relative drop in the bucket. Probably cheaper than going.
It's popcorn money, player. It's popcorn money. What's the next movie you're going to see in the theaters at an AMC? Hopefully. I
saw A Quiet Place over the weekend. It was so good.
I think the next movie I go to probably won't be till September, but I'm going to go to the Sopranos prequel in the theater for sure. I'll probably drag you with me. I feel like we should go to that as a group.
Okay.
What do you think? It's a while.
All right,
it's a while from now.
So this is legal. So you could do this, but we can't have Bitcoin inside of an ETF.
Well, let's go there. Originally, I was against the idea of a Bitcoin ETF. Like in 17, 18, I was like, why? Why does anyone need this? But a lot has changed since then. And I now believe that we are doing investors more harm than good by trying to protect them, right? So let me just read you this from Barron's. The way people are getting Bitcoin exposure in their brokerage accounts is just getting increasingly ridiculous. Quote, 2 Canadian ETFs approved just a month ago allow investors to take bets on whether Bitcoin's price will rise or fall through long and short future positions. Recently, however, they ran into some issues when the CME briefly halted trading in Bitcoin futures after their prices plunged by nearly 1/3, a mechanism intended to help slow panicky trading in the futures market. The Horizons Fund sent out, quote, market disruption alerts to market makers who facilitate trading on the ETFs in the futures exchange, warning that they would not be able to honor buy and sell orders, blah, blah, blah. There's no reason for this. There's no reason for this. Why do we have market disruption alerts on retail products involving Bitcoin futures? Because Bitcoin's not scary enough. We need people trading futures now in an ETF wrapper. Just do the thing already. What's your take on this?
Balchunas was speculating this morning that there's something fishy here. Something doesn't add up. And maybe it's the government just saying, like, nah. Say whatever you want just because they view Bitcoin as a threat.
How is this different than sports betting or cannabis?
Well, cannabis is not going to potentially disrupt our currency.
Okay, so you think maybe they're waiting to get the US dollar digital version out the door before they entrench Bitcoin any further?
Could be. I don't know. But
right.
but it's hard to justify why we're not seeing the ETF, given that you could trade triple levered anything, futures tied to whatever. There's just products all over the place that are no worse for the investor than a Bitcoin ETF would be.
Okay. I think you can't have one Bitcoin ETF, because if there were one, like let's say one got approved in January, right now it would have like, I don't know, $100 billion in assets in it. Something like that. My guess. Because Grayscale has 25 billion and it's not a legit ETF.
I think
if
they got up to
Grayscale
60.
Right, so if Grayscale were able to convert, let's say, last November or something, I think it would be $100 billion. They would now de facto be not controlling on purpose, but swinging around enough Bitcoin to literally affect that entire asset class, $1 trillion asset class.
How many companies have filed? A dozen?
12, 15. I think you need a few, because you can't have one. You can't have one fund that becomes 10% of the whole asset class, and that's what would happen if you approve one. Last thing I want to say, if we're saying one of the primary rationales against Bitcoin ETF is that the underlying market is too opaque and easy to manipulate, allow me to introduce you to the oil market, which in plain sight is literally under the control of a cartel. Like nobody is under any illusions. There are dozens of ETFs and ETNs based on oil and gas.
Okay.
So anyway, all right.
So
That's my rant.
I've been thinking about risk just from the spectrum of like how much pain, headline pain, investors need to endure on a daily basis. Just the negativity, if it bleeds, it leads type of thing. So the other week there was a headline, like Dalio said, crypto's biggest risk is its own success. And then that same day, I saw a headline from Bob Schiller. It's the Wild West or whatever. Every single day, the financial media is trying to outdo one another with scary headlines on good days, on bad days. Why? Because they're preying on our most basic instinct, which is to be scared, to look over our shoulder, to worry about the rug pull. And it's just a little bit tiresome. And you wrote something similar about this last week, that risk-free reward is the domain of charlatans. So worse than the financial media are industry professionals that prey on people's naivete and their fears.
The point I was trying to make was about this whole inflation thing now that everyone's panicking about. Prices for everything are up. But you know what? If you had put money to work in the risk assets stock market in 2011, 2012, 2013, and those assets have had 8 or 9 years to compound at an average annual rate of 14% in stocks, right? Like if you could just go back in time and do that, the higher prices that you're paying for everything right now would be very easy to keep up with. If, on the other hand, you were listening to, I wish I could say what I want to say, you were listening to basically medicine show salesmen who were telling you that you needed to be hedged. Every ounce of risk you were taking, you had to offset it with a hedge, blah, blah, blah. Not only did you not earn the 14% a year or anything even close, you may have even lost money. And now you're paying these higher prices with money that you earned 10 years ago that hasn't appreciated, which is why you have to get accustomed to risk, not spend your whole life trying to run in and out of it. It's like running down the street to avoid raindrops. Like you have to take the hits from time to time.
It sounds obvious. If you try to hedge, if you try to eliminate every risk, how do you think there's going to be any reward left over for you?
Well, that is this thing where you could turn lead into gold, and you can turn a risk-free or a low-risk approach to investing into high returns. It is the ultimate sign that somebody is basically either doesn't know better and therefore is not deserving of your assets to be invested with them, or does know better and is a lowlife. There isn't any in between when somebody promises you something that in theory and in practice can't actually exist.
So let me ask you this. Like, obviously every investor has their own sweet spot. Like, I think the key is to go as far toward the line as you can, whatever your line is, and to not go over it. Unfortunately, you only know where the line is once you've already gone over it once or twice. But do you think if there's a spectrum of risk where you have people over here who are taking very little risk because they're too obsessed with mitigating risk, and then they obviously shoot themselves in the foot because they're not keeping up with inflation, and then there's people over here that are YOLOing their entire portfolio, I would say there's way more people taking not enough risk than there are people taking insane amounts of risk.
I don't know if I agree with that. I think that's generational. I have an article in Fortune, the print, by the way. So comes out tomorrow morning at 8 a.m. But it's about the generational difference in how people are treating their portfolios. And I kind of tell the story through the lens of a father and a son. And obviously the son is like Gen Y, YOLOing. And the father is looking at the gains the son is earning and just like, why aren't I doing this kind of thing? So I don't know that there are more people taking too little risk. I think it's generational. But
that's fair.
I heard you do this on Animal Spirits. I guess this is from late last week, where you were talking about like, where is the line? Like 60-40 might not be appropriate. If you do the math and look at what the potential drawdowns have been based on history, maybe your line is 80-20, maybe it's 40-60. But like, that's an individual decision. But then the second part of that is you have to
the
live.
The line's also always moving.
Of course. After the first 5 months of this year, most people think they can take more risk than they really can. Right. And then that will reverse itself, obviously, in the next bear market. We're not going to solve that today. I want to get into Uber and Lyft. Could these be inflation hedges? What are your thoughts?
No.
Go on. That sounds definitive.
No. This morning, so I think it might be easy, and I'm using a data set of one. I looked this morning, tried to go to Penn Station from here. What do you think it costs?
To go to Penn Station from
my house,
our town?
Yeah.
Oh, I don't know.
It's like a 50-minute hour ride.
$100?
Actually, 75.
Okay.
Not at all unreasonable.
I mean, not money well spent, but
no. I'm just saying that's no higher than it used to be, and I think this is a very simple thing. Okay. The people were obviously getting paid who weren't otherwise getting paid, right? Drivers were getting paid to stay home. And they were scared of, understandably, of contracting the virus. So they said, why would I go back for this? I'm not going back. But now they're giving incentives. Uber and Lyft are both giving incentives. So even though Uber had 3.5 million active drivers that left during the first 3 months, which is down 22% year over year, in the past 4 weeks, 100,000 came back. Okay. So I think we might be on the other side of that.
Okay, I agree. And when the extraordinary stimulus runs out and the enhanced federal unemployment benefits run out, you have a lot of states that are like not passing on those benefits for ideological reasons, the red states. When that money dries up, people are coming back to drive their Ubers and Lyfts. Let me read this to you. Like many other industries, the ride-hailing outfits say prices are up because they can't find enough workers. Okay, reasonable. But more than most other types of companies, Uber and Lyft can nimbly pass the cost of finding those workers, in their case, drivers who are treated as contractors, directly to their customers. By Uber and Lyft organizing themselves with the drivers being contractors, in a sense, they have put the riders in the position of employing these contractors.
That was a great line.
Great line. So, like, nobody's putting a gun to your head to take an Uber, but if you want to, the drivers are effectively setting the price.
Yeah, no. Can I reverse what I just said? I think maybe I was too quick to say no. Maybe they are a decent inflation hedge. Like I know it sounds silly, but I think there might be something there.
Full disclosure: I'm long Uber. I don't own it because I think it's an inflation hedge, but that would be really interesting. Okay, let's keep moving.
We spoke about silly inflation hedges, and now we're talking about Uber and Lyft.
Exactly. Yeah, sorry. Oops.
Okay. All right, last topic. So there was a blog post called "More to That" by this guy Lawrence Yeo, and the title was "Speculation: A Game You Can't Win." And I love this chart. He's showing what happens when you buy a stock and it does well and you sell it, and then from there, there's two possible paths that it could take. One is it goes up a lot and you feel like an asshole. Oh my god, I left so much money on the table.
Mike, you just broke the rule.
What's that? Oh. And then the other possibility is you sell, the stock goes down, and you're like, you idiot! I knew it. I knew I nailed it. And so here's what he said. Here's the thing about speculation: realized gains will feel like penalties when they're interpreted as missed opportunities. Walking away with a great 10x return will make you feel terrible if that came at the expense of a future 100x return. So then he talks about the other side, Schadenfreude. Whichever path the assets end up taking, there's a mental tax to be paid on top of any monetary result, and that's what makes this such a difficult game to internalize.
I really like this post that you shared with me. I've never heard of this guy. Do you know who he is?
Nope.
The
I saw
blogger?
Barry tweet it. I never saw him. No.
Okay, it was really well done. The illustrations were cute, and the charts are great. And I agree with his point. People not only want to sell at the top of something, but then they also want it to get killed after.
Yes.
I don't know the reason why, but I am 100% like that. And I used to joke around with JC.
I think
when
everyone
is. When we used to get out of a stock, like JC and I would look at each other and we'd be like, I hope this thing goes to zero.
Negative zero. Yeah.
I don't know why that is. Is there anyone not like that, or is everybody like that? And what is that about?
I feel like Ben Carlson's probably not like that.
I don't think it's Schadenfreude, though. I think he has this wrong.
What is it?
I think it's like
That's
vanity.
true. It's not.
It's like, look how smart I am. I got out right before it tanked. I don't think they want other people to get hurt.
True. That's true.
I think he has that part wrong, but it's funny.
That's true.
It's definitely funny. All right, Duncan's gonna come up and do some viewer topics. Where are you, kid? All right.
Hey guys.
You're in the HQ today.
Yep. You can tell with the new sound panels, right?
No doubt. Actually, before you start, we're going to do a 20% discount code for anyone submitting viewer topics to the show. So you guys are giving us great ideas. We love them. We want them to keep coming. So if you want 20% off animal spirits or compound merchandise, send us a viewer topic, and Duncan will shoot you the discount code for a limited time only. You can send an email to askthecompoundshow@gmail.com. All right, what's the first one?
Okay, so first up today from Jay, we have, do you think these cybersecurity attacks could lead to the next major Black Swan event for the markets? And since we have a lot of young investors, maybe if you can also just explain what a Black Swan event is in the market.
Mike, you want to explain what a Black Swan is?
Yeah, just it's probably something that comes out of absolutely nowhere. Is that probably the simplest way to describe it? Something we've never seen. Not only does it come out of nowhere, it's something that we've never seen before.
Yeah, it's Talib's book called The Black Swan, about how nobody ever knew a Black Swan existed from Europe until they showed up in Australia and they saw one for the first time. So 2008 was considered like the mother of all Black Swans for our generation. It was something nobody could have ever imagined. Nationally, home prices declining to the extent that they did, because it's never happened before.
Or oil going negative was a Black Swan.
I actually think like the highest probability candidate for the next Black Swan is either an environmental event that we can't even imagine, like some massive earthquake beneath like a major capital city that completely disrupts insurance companies, banks, finance, stocks.
King Kong and Godzilla come out of the center of the earth.
Or something maybe a little bit more ripped from the headlines, like a massive cyber attack where the balances of people's accounts get wiped out to zero and nobody knows why. Either money gets stolen or data gets stolen, and all of a sudden there's like $1 trillion missing. I really think that that's the one. And I don't think that there's anything that can really protect you if something like that happens, including gold. I think everything's going down on that news.
So you know what I did today when I saw that headline, or yesterday, the other day, I pulled up a chart of Beyond Meat. It's like, oh, it's a beef storage. Let's see what Beyond Meat's doing. It is the worst looking stock chart I've ever seen over the last 2 years.
The other day,
it fell 80%. Then it got cut in half. It is all over the place. Terrible looking chart.
If you think the chart's bad, you should take a bite of that shit.
Hey,
all right.
Hey.
We're talking. Right. Duncan's a vegan. I like the Impossible Burger.
Come on now. Okay,
no need for that, Josh.
I'm just kidding. I never actually tried it.
I have. I love it.
There you go. Okay, so next up we have a question from Daniel on Long Island. What's your take on when and how to sell a holding? Wait until it's up a certain percent, unload all your shares at once, or a portion at a time. I know there are a lot of different factors, but wanted to keep the question simple. Love the show. Keep up the great work.
Fibonacci retracements.
Yeah, this is the hardest. This is the hardest question. I don't think anybody's got great answers on this. I mean, here's what I would say.
Great show.
No. Hold on. I'm about to give some advice. Okay. Before you buy something, assuming that it's not a forever holding, which let's be honest, few things are, I would say have some sort of game plan in place. So if you buy a SPAC at $10 and you want to get lucky and you want to hit it at 15, then sell it at 15 or whatever the case may be. But you have to have a plan in place before, because if you're like, well, I bought the stock and now I'm up 40%, I really have no idea what to do. You're toast. It's impossible to operate under those in that scenario.
Okay, so I did this on TV for somebody that asked the exact same question. I wish there were a formula, because somebody would have shared it with us, and then we would pass it on, and it would be simple. But I do think that you're on the right track, Michael, and I would just like embellish and say, before you go into investment, define what you're doing. Are you investing or are you trading? If you're trading, it's simple. You're probably using trend in some way, or some kind of defined catalyst in the future. I'm trading this into the earnings on, for example, June 9th. Okay, so now we know what the reason is that you're in it. Or I'm buying it because it's in an uptrend. Those are very simple situations to say, here's where I get taken out of the stock, right? It broke its uptrend. Okay, I sell. So that's if you're a trader. If you're an investor, it's different. If you're an investor, you shouldn't even be thinking about, when do I sell? The question should be, when do I get an opportunity to buy more at a better price? So you have to know if you're investing or you're trading in every single situation. When you hear me talk about individual stocks, they're all investments, because I don't trade. I might have to trade, but the intention is never, let me catch this thing in an uptrend. I'm just not. There's nothing wrong with it. It's just not where I'm at these days. I don't have time for that.
All right, I have to say, well said. I have to say something important. Neither you nor I knew that the other one was going to be wearing this shirt today, and
Yeah, what's winning though?
we were also unaware that you were going to be Brown of Easttown and I was going to be Michael of Easttown. Completely, we're not that cheesy.
I think we hang out too much. I think even though you and I are going to the Knick game tomorrow night, but after that, that's it. No more hanging out. All right, I want to thank Duncan for coming through with the viewer topics. I want to thank everybody who joined us for the live stream. We love you guys. We'll be back on Tuesday. Remember what I told you this Friday. New podcast coming out. Get hyped for that. It's going to be sick. We've been working on this all spring and summer long, and we will see you guys next week. Subscribe, like the channel, do all the stuff. All right.